Well, it was a soft quarter for metro brands. Their expansion expenses hit EBITDA while profits declined on high depreciation. Nissan Joseph is Chief Executive Officer at Metro Brands, and he's joining us now to take some questions. Mr. Joseph, great to have you with us here. Thank you very much. Have you seen any general slowdown in discretionary spending in the quarter? That kind of thing build up?
So thank you for having me this morning. I think it was actually, when you look back at it, it was actually a good quarter for us because there was a lot of normalization that happened through this quarter. So last year, we had our best quarter ever in terms of growth post-pandemic. And last year, we had no closures. We had a lot more wedding dates, and there was a lot of pent-up buying and a lot of wardrobe refreshes that happened. Given all that big push into the quarter last year, to come out at this side of the quarter on this year and be that close to that target, I actually am quite pleased with the numbers. The other point on demand that you bring up is, we've seen growth in our e-commerce business of about 68% quarter on quarter, which also signifies that the demand continues to be strong because e-commerce did not have any pent-up buying last year that they had to comp this year. That's number one. Number two, when you look at our growth on the products over 3,000 rupees, we went from 44% in the previous quarter to 49% this quarter. So that also shows that the premium consumer is out there shopping and willing to spend their money at Metro Brands.
Mr. Joseph, what's the same-store sales growth for Q1, and what's the outlook you have on that for the rest of the year?
So we don't break out, Surabhi, our numbers by like for like. Having said that, though, I think we were within the same pin code on those numbers, as you can decipher looking at our growth and calculating the new store effect that we would have had. However, as I look to the coming quarter as well, we did continue to see pent-up demand go through about 6 months, well, probably 4.5 months, which goes into Q2. And this year, don't forget, travel is up big, eating out is up big, whereas last year we were still wearing masks on planes and masks in restaurants. So given all that push on the discretionary dollar, or the discretionary rupee, I'm actually quite pleased that we have come out with the numbers we did. And if you really look at our standalone numbers, our profit was up. Our EBITDA continued to be in the 35% range. Surabhi, we've always guided that our profits would be the path would be somewhere between 15 and 17%, and our EBITDA would be in the 35% range. So while we were trying to comp and go against some very big numbers from last year, the fact that we've continued to hit those numbers in terms of the measurables of PAT and also EBITDA percentages makes me feel very good about the performance of the team, but also to see that the demand continues to be very strong for our products. The fact that, as I mentioned, that we could be in the same zip code as we were last year with all that pent-up buying and wardrobe refreshes and auspicious wedding dates that seem to be jammed into Q1 of last year.
All right. Hi, Mr. Joseph. Good morning. Give us a few numbers then. Store openings, I think, in the first quarter were around 27. For the year, I think you were gunning for close to around 100. Do you stick by that? Point number one. And also on the acquisition, Cravatex, which is Fila, you have done close to around 17 crores. What is the run rate you do for this year?
So, when we looked at our new store growth, we had upped our guidance to open 200 stores in 2 years at the last call. And we're very much on track with that. I feel very comfortable with that number as we look to our runway and our the sites, the Whitefield sites that we've identified for our new stores, both from a backfill strategy. So where there's a Metro doing well, we know we can go and backfill with other banners that we have, whether it's Mochi or whether it's Walkway or Crocs or FitFlop. I also feel that there are new cities that we will continue to look at. Last quarter, we expanded just to 8 cities. We've identified over 50 cities that Metro could eventually be in. So when I look at the growth runway, I feel very optimistic that that number is something we would definitely hit. When we look at Cravatex, we've spent all our time ensuring, as I mentioned before, cleaning up the inventory, rationalizing our distribution, and repositioning the brand. And the run rate that we look at it is going to be very dependent on how fast we can liquidate product. We can expect Cravatex to be a little bit of a drag on our profitability through this quarter and maybe the start of next quarter. But by then, our goal of having cleaned up that inventory and repositioned Fila brand so we can start unlocking the potential of Fila would be well on its way.
So when you say the drag will continue, maybe Q2, a little bit of Q3, Should we expect that perhaps Q3, if not Q3, Q4 onwards, Gravitex will become positive at the EBITDA level?
Yeah, that is our target, though we're not trying to give any forecast definitely yet. But, I firmly believe that we should be able to, and we will be able to rationalize the distribution, which adds a lot to the bottom line of that standalone business unit.
Okay, you mentioned that we're still on track with store openings. I think the earlier number that you gave us was about 260 stores over 3 years. How much of that growth will happen this year, FY24? The reason I also ask is just trying to pencil in if that means higher store opening costs that could perhaps keep putting that pressure in the near term, at least, on the margin line.
So just so you know, we upped our guidance. We were at 260 stores over 3.5 years when we first went public, survey, but then we've upped it to 200 just on the back 2 years alone, having well exceeded the first half of the year. So from that standpoint of the original 260 stores, we're going to by far exceed that number, right? And thank you for pointing out the EBITDA drag. As you know, Ind AS expects us to put a lot of depreciation into the first year of a new store, and that's why you would see some pressure on the EBITDA. However, despite that pressure from all the new stores that we've done, and with the Ind AS reporting, I'm very pleased that we had a 35% EBIT.
Okay. All right, Mr. Joseph, we will leave it on that note for today. Thank you very much for joining in and giving us a lot more detail on the business and the outlook ahead for the year. That is Metro Brands. Numbers looking quite all right at the end of Q1. Margin pressure, as he explained, because of a lot of the new store openings and this new acquisition, Fila, which they've done, which for the time being right now is loss-making at the EBITDA level. Anyway, we've